Yeah, good afternoon, everyone. Can you hear me?
Yes, I can hear you.
Okay, good. So we can just get started. So let me share my screen. So let me share my screen. Okay, let me minimize this. Okay, so I just talk about this year. So that's 2022, and when 2021, and this is stay away from positive person. And so 2020, 2029, before the COVID, we stay away from negative people, and then 2020, we stay away from positive people, and in 2021, we stay away from people, just hide at home. And then 2022, and be positive and be patient. So, so I'm pleased. I got almost recovered. So I still needed to, I still needed to have a couple of days and quarantine. So I want to protect you guys. I don't want to pass on the virus to you guys. Okay. Today's topic we are going to talk about this week is going to talk about this is going to be, let me see the chapter, chapter 2. So while I'm talking during this process, you can interrupt me anytime, and when you have any questions. Okay, so the this chapter we talk about is going to be the nature of a bank. In the United States, we have two major types of banks. Okay, one of them is a commercial bank, and another one is is investment bank. So what are the major difference? So what are the major difference between investment bank and a commercial bank? You might, how do you know this bank is a commercial bank or that is an investment bank? Let me say, I give you a question, what is JP Morgan Chase? Do you know JP Morgan Chase is an investment bank or that is a commercial bank?
Definitely a commercial bank, I think.
Commercial bank, okay. So what about a Bank of America?
Commercial?
Is a commercial bank, okay. So when you wanted to know that bank is a commercial bank or is an investment bank, how do you know the difference? How do you know the difference? What are the major difference between commercial bank and an investment bank? Can you ask a simple question, to figure out this bank is a commercial bank or that this bank is an investment bank? Okay, let me show you top US investment banks. So we use the data from 2021, 2022, or 2020, they are the same. Yeah, let's see. So you can see my screen, right? So when you watch my screen, you see the top US investment bank. The number one, Goldman Sachs. And number two is Morgan Stanley. And number three, JP Morgan. Okay. And is that surprising that JP Morgan is an investment bank? Maybe this the most recent, this is the most recent. So we can using a different resource. Let's say this is Wikipedia. Wikipedia says, okay, number one, JP Morgan Chase, number two, Goldman Sachs, number three, Bank of America, and number four, Morgan Stanley. And then the five is Citigroup. So you can see, did you see any question about that? What are the difference? JP Morgan Chase? Yeah.
Oh, I was gonna ask, like, just commercial banks, because like you would go to commercial bank to like set up your checking and your savings like account. Is that like it's focused more on like personal, like management of money, whether like for investment bank, or is it like is investment still on people?
Yeah, you have a good point. See, commercial bank, they do checking and saving account for individuals, and for investment banks, they don't. So you cannot open a checking or saving account, in that investment bank, but you can do a checking or saving account with a commercial bank. Okay, so this is the why. Let's say JP Morgan Chase, you have a checking account with JP Morgan. And you might also have a checking account with Bank of America, right? So Citigroup or Bank of America or JP Morgan Chase, they can do both. So they are commercial bank and they are also investment bank. And most of the time, most of the banks, they do only one. Okay, either do commercial bank, they either do investment bank. But like JP Morgan, they do both. They are commercial bank and also investment bank. Okay, so basically, usually we talk about like a big four in the United States. The big four, like you have, if you have a CPA or accounting, so you talk about big four, right? Big four accounting company. And also in the bank, we have a big four. The big four are, Morgan Stanley and Goldman Sachs. And also before year 2008 financial crisis, they have Lehman Brothers and also Merrill Lynch. So Merrill Lynch right now is, is merged with Bank of America. So Bank of America take over Merrill Lynch, after the 2008 financial crisis. So the mainly you wanted to ask in the question is, if you wanted to see the commercial bank, you wanted to see, you just ask a question, okay, can you take deposits and can you do checking a saving account, right? So that is the main, how easy you can tell the bank difference, is that a commercial bank or investment bank. So investment bank, basically they do business of issuing securities for the company, and that's the investment bank, the major business. They do not have checking a saving account for individuals. Okay, so we have the bank is decentralized. Okay, remember, so this is in the United States. And one of the words we need to remember is is called decentralized. Okay, decentralized. So the US bank systems are decentralized. What that means, decentralized, is that you can see the banks, they have different branches and located in different locations, and they are supervised or monitored by the Federal Reserve. And the Federal Reserve has 12 different branches. You know, each branches, they supervise the local commercial banks in that area. So that is decentralized system. So you have large international banks. Also, you have quite a lot of regional banks. Okay, so we wanted to, you know, today we want to focus on the history of the bank deregulation in the United States. So what is the bank US deregulation? So US bank system actually is a system we call the deregulation. Okay, deregulation. So you might wanted to know what is that, you know, is it called deregulation? So I'm going to show you the documents I have here. Okay, you go to the course portal. Actually, I have one of the very important documents that could help you with your discussion forum question. Let's click on the discussion forum. Okay, you can see here, I give you the question for chapter 2. And how did concentration in the US banking system change since 1984? Okay, what are the major change in the United States in the banking system since 1984? Okay, 1984, you can see some of the major changes. You know, is 1970 is the Bank Holding Company Act, and in 1994 they have the Regular New Interstate Banking and Branching Efficiency Act. So all those are law, you know, all they passed by the U.S. Congress, and you can see all those laws are very important law, and those process we're talking about is called U.S. banking regulation system. Okay. Another question is this one. So what are the registration, okay, regulation Q and section 20 talking about? Okay. I think, oh, this is a, okay, this is called a regulation Q and the section 20. And so what is means by too big to fail? And what does it mean by net interest income? So any idea about what happens in the US banking system? So anyone know what is regulation Q and section 20?
You said that one was regarding the too big to fail statement.
Uh-huh.
That
Yeah.
It's when like a bank gets so big that like it's a pretty much a vital part of like so many people's like wealth and like their money, that if they were ever to like declare bankruptcy or become solvent, the government would come in and like supply funds and stuff so that they wouldn't necessarily like fail or like go under, because then it would probably cause a lot of like ruin for everybody and just set off the whole economy.
Mm-hmm. Yes, that's the problem with the too big to fail, and they have the bank, you know, in danger of a default of failing. The government will using the bailout money. Okay, that's that's why, you know, too big to fail has a moral hazard problem, and that's because the manager, they are not going to really take those customers risk into consideration or into their heart, because when the bank just bankrupt, and you know, it's not the bank's business, and because it's going to affect all the depositors, and so it's going to has that Moral hazard problem is the manager of the banks. They only concerned about the return because the return is related to their compensation. They are not going to really concerned about the risk. Why? Because the risk is going to go back to the government. So if the bank is bankrupt, they know that the bank bankrupt, the government will use the bailout money, and it's not going to affect the bank. So we need to go through all this. So that's the discussion topic. So I wanted to show you what exactly the bank system changes during the past. Otherwise, you will not going to understand what I'm talking about for this discussion topic. Okay, this is the documents I posted. I'm going to show you the documents where I posted. Let me show you here. So we go to the cross-counted. We chapter 1 and 4, and we have the introduction to risk. Okay, let me see additional resources. Okay, let me see. What's the documents we have? Where is documents? Oh, I think maybe. Okay, I'm going to post that document. I think it's not here. So maybe let me see we posted right here. YouTube, not sure. Okay. Okay, sorry, it's not there, but I'm going to upload that file. It's called Bank Deregulation. Okay. Yeah, this is the timeline of banking legislation. And the whole process we are going to talk about is called bank deregulation. Okay. And so the first is we starting back from 1913. Now 1913 is the Federal Reserve Act creates a Federal Reserve System. Okay, that is the US central bank system. Okay, the US central bank system is the Federal Reserve System. So create the US Federal Reserve System. And in 1927, they have a McFadden Act. So what is the McFadden Act talking about? They prohibit interstate banking. So what that means? So if you have a bank in Texas, right, you are not going to be allowed to have another branch in Louisiana or Mississippi or California. So you can only have interstate bank. Okay, you cannot go over the border into another state. This is 1927. 1933, it has called the Glass-Steagall Act. The Glass-Steagall Act established Federal Deposit Insurance Company. So this is the one we call FDIC. So now you can see you go to any of this bank, and you can see the bank that they have FDIC insured, right? They have a plate, and you can see the bank they have FDIC insured. And they established two important law. One of them is called Regulation Q. Regulation Q, they set up interest rate ceilings. So you see the ceilings is on the top of the roof, right? Then when you go to your home and you go back home, you see the ceiling. Ceiling is the top one, right? On the very top. So Regulation Q says, okay, this bank, you cannot charge interest rate above that ceiling. Above that ceiling. So what that means is that you cannot charge a high interest rate. So the interest rate you can charge is only limited to that level. And another section Q prohibits the Federal Reserve member banks from being affiliated with any organization that is engaged principally in securities underwriting or dealing. That's a section 20. Section 20 says if you do, okay, your bank is doing commercial bank business, you are not allowed to do investment bank business. So investment bank business is the main business is issuing securities or do IPO or underwritings, you know, for those commercial bank, for those business. So, so we can see what is regulation Q, what is a section 20. So I just talked about, anyone can answer my question, what is regulation Q and what is a section 20? Any student can understand, answer that question? What about Ben? Ben, can you hear me?
Yeah, I can hear you.
So what is a regulation?
I can hear, I just don't know the answer.
Huh? So what is a regulation Q and what is a section 20 talking about?
I've heard
I
about.
have no idea.
I couldn't tell you off my noggin.
Huh?
I couldn't tell you off the top of my head.
Okay, this is the one I just talked about, okay? And a regulation Q and a section 20 is one of the, both of them are the very important clauses in 1933, the Glass-Steagall Act. So the Glass-Steagall Act says a commercial bank or investment bank, you cannot charge interest rate beyond that interest rate ceiling. So high interest rate is prohibited. So you cannot charge interest rate higher than that. And then section 20 says, if you are doing commercial bank, you're doing deposit and you open checking account for individuals, you cannot do security issuing or underwriting. So that means if you do commercial bank, your bank is doing commercial bank's business. Okay, I'm sorry, you cannot do investment bank business. So at that moment, investment bank and commercial banks are strictly separate. They cannot do both business. Is that clear, Ben?
So section 20 just separates commercial and investment banking.
Yeah, no, I knew about that. I just didn't know that was the provision that was pertinent to that, I guess. I didn't know that's what.
Oh, yeah. You know, you need to understand. Okay, so basically, you can see the law. Okay, 1927. Okay, so interstate bank is in McFadden Act. McFadden Act talking about your bank cannot open branches out of your state. Okay, you have a bank in headquarters in Texas. You cannot have a branch in Louisiana or Mexico, New Mexico, or somewhere else. So you can limit only to the business in your state. And in 1933, they have a Glass-Steagall Act says, okay, you cannot charge high interest, and you cannot do investment bank and commercial bank business at the same time. So what do you think after this, those regulations? Okay, what do you think the bank in the United States? They are pretty big or they are small? Can they grow in bigger?
Do you mind asking that one more time?
Okay, when you see the law I'm talking about, right? What do you expect the bank in the United States? Can they grow bigger?
Oh, based on what we just went over, I'd probably say that they'd get not bigger, stay small, because they can't do like the interstate banking and they can't charge high interest rates. So it kind of sets them up not to grow bigger, is my guess.
Yes, exactly. You are right. So you see those laws and they limit the bank. The bank cannot grow big, right? So you are not allowed the banks to have a business out of the state, and you cannot charge high interest. How can the bank make a profit? Grow bigger, and they are not allowed to do investment bank business, right? So the bank cannot grow big. So what happens is that when we talk about 1933, okay, late 1920s, U.S. has financial crisis, is a Great Depression. Okay, the Great Depression is they have bank run. So the bank run, because those are small banks, they're starting to bankrupt. A lot of U.S. banks are bankrupt because the banks are small, right? They're small. Okay, so this is the discussion question talking about. What did the concentration in the U.S. system change since 1984 or 1980s? The change is this, okay? 1980, they have the Depository Institute, Deregulation, and Monetary Control Act. This is called the DIDMCA. The 1980s, the United States is starting to realize this is the problem. So our banks cannot grow bigger because we limit them, okay? In the 1980s, the DIDMCA Act removed the ceiling of interest, right? They removed the ceiling. Okay, they removed that and they established a uniform service requirement and also increased deposit insurance. Okay, the ceiling of interest is removed. So now you go to the pawn shop next to your neighbor, street, and you can see the pawn shop, they can charge you interest now in the United States, 5,000%. No interest rate limit. Okay, that's the fact in the United States. In the 1994, they have the Interstate Banking and Branching Efficiency Act. Okay, they allow interstate banking. Okay, 1994, your bank can has business all over the country. It's not only limited to Texas. You can see JP Morgan Chase in New York, in California, and in Texas. So anywhere, right? Okay, 1994. And in 1999, they have Graham-Late-Bailey Act, allow the bank and other financial institution to affiliate each other. This is called a financial holding company. Okay, that's what we can see. JP Morgan is a commercial bank, and also it is an investment bank. So you can see the act changes that situation. Everything completely changed. Remove all those limits, and then the bank, they could do high interest rate, charge 5,000%. They can do different states, and they can do investment bank and commercial bank at the same time, right? So you can see this, that's what I'm talking about. You can see the Bank of America, right? They are both commercial bank and investment bank. JP Morgan, Citigroup, Citibank, all those are the same, they do both business. So what are the problem? Okay, so the problem is, you can see when the bank, they remove those limits, the bank is becoming very big, bigger and bigger. So the bank become bigger and bigger. So that's the big banks. So why is that not good? So the bank is too big, they have a big bank. So what do you think if the bank is too big? What is the drawback of that?
If they get too big, like we can get too dependent on maybe like one or two, and if something like goes wrong with them, then it would affect a lot of different people, maybe.
Yeah. Okay, so I always suggest my students to watch. If you have like a Netflix or something, you can do using to watch the video. Is called Too Big to Fail. They have the movie. Is called Too Big to Fail, and explain the financial crisis. That's the the movie Too Big to Fail. So the Too Big to Fail is talking about what exactly happens, why that caused financial crisis. And okay, in the United States, one of the major problem with the bank are too big and too fail is that, so we're talking about the too big to fail is the manager, okay, or the CEO of the bank, they are not worried too much about the risk of the bank. Why? Because do you know the FDIC insured? What that means? How much money is insured?
$250,000.
Exactly. So it's a 250,000. So the standard deposit insurance cover is 250,000 per depositor. So that money, okay, that money is secured by FDIC. So the bank, they're not worried about the bank gonna bankrupt because the depositor asks the bank to pay their money back. But they say, okay, no, we are FDIC insured. You can go to the Federal Reserve, ask for up to 250,000. So the bank does not care about the risk anymore. So what they care is, you can see the top CEO in the US banks, how much money they got, their annual compensation. Most of them, over 20 or 10 million US dollars per year. They care about the bank become profitable and higher return, and they can increase their compensation. So they are not carried about the risk. So they just pursue the profit. So the profit, higher risk. So that's the problem with the too big to fail. So that's, you see the 2008 financial crisis, all the banks, they have the all kinds of business, right? And this CBS, and CDA, all that different financial securities, and then they got bankrupt. So the too big to fail problem has put the bank in much higher risk, and then nobody gonna take responsibility for those risks. They pursue the higher profit. That's the reason why they cause the whole system gonna bankrupt. And also the bank are very big because they took money from all the depositors. So the government wanted to have they don't want a rights, and they don't want to have the ordinary people, they lose their money. So the government wanted to have the whole society stable, and then they will pay the depositors, and they are not going to blame the bank. That's cause a huge consequence to the whole society. Okay, so that's the movie is called Too Big to Fail. Okay, let's let's go down talking about these documents, and this is the details about those the facts of those. In reality, that happens. Lehman Brothers in year 2008 bankrupt, and they create a Dodd-Frank Act. Actually, when Obama is president, they used the taxpayers' money to pay for the bank. Some of the bank, they got bailout money from the government, but they just let Lehman Brothers bankrupt. So that is Dodd-Frank Act. So they pay those money to all the banks. And also I heard that, that year, and a lot of middle level managers or top level managers, they still get millions of US dollars bonus. They use the government bailout to pay their as their bonus, even in 2009 and 2008 financial crisis. That's a lot of people blame about that. Okay, so that's the US system. Is basically that system is called deregulation. The whole system is deregulation, and then at the very beginning it's too tight, and then they got a financial crisis. They caused bank run, and then after 1980s, they starting to remove all those limitations, and this process is called bank deregulation, and the bank become bigger and bigger. So then they cause the problem is too big to fail. Okay. And I post this one. This is the project. I'm going to post this project for you to do. Remember, you need to collect data. Let's say you do Apple and ExxonMobil. So you can collect data 2021, and then you do all those 2021, and you have the data, calculate return, and you get a return and a standard deviation, calculate the correlation, and then using my example, you can draw efficient frontier similar to the textbook figure 1.2, and then you calculate the Sharpe ratio to maximize the Sharpe ratio given the risk-free rate. That's your project. So I'm going to post this project. You can work on this week, and you can turn it in next week until I think next week, maybe next Monday or Wednesday. Okay, so I'm gonna post this document, the project for you to complete, and also I post the lecture notes, the timeline of the US bank legislation. Okay, any other questions? Okay, any questions?
No questions.
Okay. Okay, Alan post this two documents, and you're starting to work on those the project. Okay, let me know if you have any question. Okay, that's all for today. We're gonna have the same Zoom meeting on Friday at the same time. Okay, see you on Friday.
Bye. Thank you.
Okay, you're welcome.